You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Ibstock, Entain, Hargreaves Lansdown, Tritax, Coca-Cola HBC, and our US company of the week is Disney. Sam, do you want to kick us off with our favourite brick maker?
Absolutely. So Ibstock have come out with their half-year results, and half-year revenue fell 20% to 178 million, which was below market expectations of 204 million. The miss was driven by worse residential sales volumes and a decrease in selling prices. Underlying cash profit fell 40% to 38 million, in line with the group's expectations. Underlying free cash flow improved from an outflow of 22 million to an outflow of 16 million, reflecting lower levels of investment into the business. Net debt rose by 49 million to 138 million. The group is encouraged by an improving trend in sector-led indicators, but the impact on the current financial year is likely to be limited. As a result, the second half underlying cash profits are set to be broadly in line with the prior year's 44 million. An interim dividend of 1.5p a share was announced, and that's down from 3.5p last year. And the shares rose 1.6% following the announcement. In terms of the headwinds currently facing the business, obviously the higher mortgage rates are affecting affordability for housing, and we're seeing that in the house builders that we have covered recently. House builders are generally more conservative about starting new projects, and that's why volumes and prices have dropped for Ibstock. It's also worth noting that brick makers have quite high fixed costs because the kilns require a lot of energy to heat up, and unfortunately they do still have to pay for those kilns. In terms of valuation, Ibstock trades at forward price to earnings ratio of 17, and that compares to a 10-year average of 12.5, and the prospective dividend yield is 2.9% compared to a 10-year average of 4.5. In terms of the share price, the shares are actually, despite how poor these results are, quite similar to the house builders. The shares are actually doing okay. They're not far off the 12-month high. They're at 183p, and that compares to a 12-month low of 118p. And it's interesting as well because on a normalized basis, they're probably trading at a PE ratio of about 12 or 13, but the forward PE is 17 with these obviously poor results. I just find it quite interesting because it's quite similar to the house builders, where I think although the results are not great, the market is basically sort of discounting those results, probably because of all the long-term tailwinds that the industry has. The same ones that, we're not building enough houses. Labour have made it clear they want to build a lot more houses, and someone needs to get the bricks from somewhere. And the good thing for Ibstock is that bricks are not something that's very good to import because they're quite bulky and heavy, and they're also quite cheap, which is a bad combination. So I do think there's a lot of long-term tailwinds for Ibstock. So I do like it, but I don't know. I understand why it's being priced how it is because I do agree with those tailwinds, but I think a forward P of 17 when it's got, having these quite poor results, I think for me, I probably would have, I don't think I'd have bought it anyway, but I would have liked to have seen it drop maybe before I actually took any interest in it. But I sort of understand why it stayed at the level it has. What about you, John?
Yeah, I mean, I would agree with you in terms of the longer term fundamentals and tailwinds with the business. I think you would expect with the house building under the new government that it would be a major beneficiary of that. So I can see why the valuation is as it is, and I certainly wouldn't bet against it. I think it is overall a decent company, and I think, as you mentioned, it's extremely expensive to import bricks. I appreciate energy costs aren't cheap for the kilns, but I think overall I would back Ibstock. Right. On to the next company then, Entain.
Yes, what have they been up to?
It's a good question. So Entain, we've covered it a few times now. It's one of the UK's biggest gaming companies. They had their half-year results out last week, with Entain's underlying net gaming revenue flat at £2.6 billion. Second quarter growth offset first quarter losses, and the business received a boost from the Euros and a positive regulatory development in Brazil being rolled out faster than expected. Underlying cash profit, EBITDA, was up 5% to £524 million, but operating profit fell by 6% to £388 million, reflecting higher non-cash charges and an increase in share losses from its US joint venture, BetMGM. Free cash flow fell from £191 million to £122 million, driven by higher interest payments, and underlying net debt came in at £3.3 billion, which was around £700 million higher. Guidance for the full year net gaming revenue performance has been upgraded from a small decline to a small increase, and underlying cash profit is expected to land between £1 to £1.1 billion. And Entain has proposed a 5% increase to interim dividend of 8.3 pence a share, and the shares were up nearly 7% in early trading. In terms of valuation, the group have a market cap of just under £3.9 billion and trade at 11.8 times forward earnings compared with a 10-year average of 14.3, and they have a prospective dividend yield of 3.5% compared with a 10-year average of 4%. I think for me, these results were disappointing. I appreciate that the first quarter had been particularly difficult for the group and they had got a boost from the Euros. My worry, and the reason why I liked the business, not that I'd invest in it for sort of on an ESG basis, but the reason that it was attractive from an investment point of view, I would say, was the US joint venture BetMGM. And I think if that is faltering a little bit, I think the investment case for Entain is also faltering a bit, because I think that's what differentiated it from the other bookmakers in the UK and potentially made it a more attractive investment. That does seem to be baked in though, and I wouldn't say it just under 12 times forward earnings. It's an expensive stock at all. It's got a decent dividend. And overall, I think the trend without, with these small hiccups is probably still there. So I could see the investment case being made for Entain and probably still more appealing on that basis in terms of the long-term view than the other UK bookmakers. It's not an industry I'd invest in, but it would probably still be the one out of that group. What do you think, Sam?
Pretty similar. I think the results are quite disappointing, and I would agree that I think the main investment thesis for me would be that US market. And like you say, if that's starting to falter, a lot of that goes away. I think that's probably reflected in the share price, because I mean, if you look at it in the past year, it's just taken an absolute hammering. So it's down 55%, and it's down 70% in 3 years. So I think a lot of that optimism seems to be disappearing, which I find strange because I think up to now, I've always felt like the US results have been quite good. This is probably the first wobble that I've seen from it, but maybe the markets are more forward-looking than we are. Yeah, I think very, very disappointing. Hopefully we come back in 6 months or so and it was just a wobble and they've got back to growth. But if competition is heating up in the US, I mean, there's not really that. I don't know. I don't gamble, but I guess there's probably a degree of brand loyalty in that you'd think once you've set up an account, a lot of people just stay with the one they've got. But in terms of like, if a lot of these markets are opening up, I think it seems like gambling like online and stuff would be relatively sticky. But the problem is in terms of whether you go with, I know I'm using UK companies now, but whether you go with, if you're thinking of opening up a gambling account and you go with Bet365 or William Hill, which one you go with, I mean, it doesn't really make a huge amount of difference. It's very, very hard to actually get that. If there's more people basically advertising, I think it does become tougher and tougher because it's really hard to differentiate yourself unless you just give such generous rates. It becomes unprofitable.
But I suppose you watch the football and it's all about the joining fees, isn't it? They'll give you quite generous free bets.
Yeah, but the problem is if everyone's doing that and everyone's advertising, you can see why it's maybe going to start to reflect in these results. But 12 times earnings forward PE, 11.8. I think given it's still got that optionality, it's not really priced like you say the US business to absolutely blow everything away. But you'd hope that this was just a wobble. Now I think if you get it at 12 times earnings and it turns out this was just a wobble and the US does what people would be hoping it would do, I think it could do very, very well from it. But it is a bit of a gamble, if you'll pardon the pun.
Okay, fine. On to a company that you used to own, Hargreaves Lansdown.
Yes, the second one I used to own Ibstock as well, actually. So Hargreaves Lansdown, this is probably the last time we'll cover it on the show, unfortunately. So they have come out with their full year results, and net new business inflows were down 13% to 4.2 billion. Total assets under administration was up 16% to 155 billion. Revenue was up 4% to 764 million. Profit before tax was down 2% to 396 million. Diluted earnings per share was down 10% to 61.7p. Underlying diluted earnings per share was down 4% to 71p. Total dividend per share was up 4% to 43p. And active clients were up 78,000 to 1.882 million. And as part of the CEO Dan Olley's statement, he said it's been an eventful first 12 months, not least with the approach from the consortium, which today resulted in a firm and final offer for Hargreaves Lansdown, with the independent board of Hargreaves Lansdown intending to unanimously recommend the cash offer to shareholders. It looks like this will probably go through. The share price certainly reflects that now. I think it's basically trading at the offer price, which gives it a valuation of about 15 times earnings and a dividend yield of 4%. Not that you'll ever see any more dividends, although I think the offer is actually comprised of something like £11 a share and then a 30p dividend. So you would get one final dividend. Yeah, it looks like very likely it's going to be delisting. It's going to be taken over. Is it private equity, the Hargreaves Lansdown one?
Yes, it is, I believe.
Okay, thank you. So they'll probably just load it up with debt and then maybe we might see it spat back out in a few years' time. Who knows? But yes, sad. It's always sad when one of these businesses gets delisted. I suppose for me personally, it was quite good. As soon as the offer came in, I sold, and that was basically about the same price. The offer was at a pretty decent premium. So yeah, a year ago the shares were about £8 each, and now they're at 11. So they are up about 37%. It's spared some of my blushes slightly in that it went from basically a minus 50% position to a minus 25% position. And I think I'd had that exclusive dividends I'd had along the way of sort of 4 or 5% a year. So overall, I probably only lost 5 or 10% on it, I reckon. So not too bad considering I was down 50% at one point, but equally not something to write home about. So for me, I just think it's more sad when one of these businesses delists than anything else. In terms of these results, there's not a huge amount point covering them because you can't actually invest in it anymore, or you can, but you'll then get bought out for the same price that you've just purchased it for. But I didn't think the results were that good. I suspect the results are about to get better because the prices are probably going to increase. But yeah, I didn't think the results were fantastic, but it's kind of irrelevant, really. I only really picked it just because it's sort of, the last chance we'll get to cover it, but the results are almost irrelevant. But even that being said, I didn't think the results were anything to write home about. What about you, John?
Yeah, no, I wouldn't get excited about it. It's not a company, as we discussed many times, I was particularly attracted to. I felt like it was generally a race to the bottom with a lot of this, and the free trading platforms and I suppose some of the fixed platform fees on some other platforms really eating into Hargreaves. And yeah, that was the reason I didn't really dig into it further than that. I know you thought it had been quite an attractive price for a long time. And as it proves with private equity coming in, and I think you'd also commented before about the return on capital employed was pretty high. Yeah, I think as a shareholder, I would definitely have taken that as an offer. I think one thing that would be interesting to compare it with is possibly when you looked at Interactive Investor and the sort of price that was bought out for. It was a few years ago when it was bought out by Aberdeen Standard Life, but I don't know whether I read that they sold it was like 30 times sales or something huge for it, and it's doing all right at Aberdeen, but I don't think it's it's probably more similar to sort of Hargreaves and AJ Bell performance. And obviously there's a lot more optimism about some of these investment or DIY investment platforms a few years ago, but yeah, I don't really have that much more to add, to be honest.
Well, there's not really any point anyway, is there? I'm
Oh.
going to cover it again.
Well, so it will just be AJ Bell, basically, won't it?
Yeah, I mean we've done plus 500 before, but it's not.
Oh
I
yeah,
mean,
okay.
That's a bit of a different
It's
business
it's
model,
more,
isn't it?
yeah,
Really.
CFDs and yeah.
But even then, I probably wouldn't be in a hurry to cover that again anyway.
No.
But yeah,
But I
very,
mean,
very
AJ
always.
Bell will be.
Yeah, exactly. But it is just, I think, always sad when one of these businesses delists.
Yeah. No,
Anyway, should we
I would
move on
agree with
to
you.
Tritax?
Yes, so Tritax, we've covered it a few times before. They had their half-year results out to the 30th of June. Operating profit was up 29.6% to £123.8 million. Adjusted earnings per share up 10.4%. They'd increased their dividend payout by 4.3%. And they'd commented in terms of their completion of strategic acquisition of UK Commercial Property REIT Limited. A high-quality urban logistics portfolio complements their existing strategy to broaden client offer and increase income and capital growth potential with 41% rental reversion. Delivers cost savings, supporting immediate earnings growth and enhances balance sheet strength by reducing their leverage. And non-strategic assets provide enhanced scope for capital recycling, with first disposals expected in Q4 24. In terms of the overall portfolio value now, that's worth an estimated 6.4 billion, which is up 27% from 5.03 billion. And it's a loan to value of 29.9%, which is down nearly 2 percentage points. They also comment on higher net rental income and DMA contributions supporting adjusted EPS growth, 10.4% increase in adjusted earnings per share to 4.35 pence, compared with first half of 23, which was 3.94 pence, driven by net rental income growth and development management agreement income. Adjusted earnings per share, excluding DMA income, grew by 4.1% to 4.1 pence. And the 34.7% increase in contracted annual rent to £303.4 million, driven by UKCM acquisition, rent reviews, and asset management. EPRA cost growth of 12.5% is expected to reduce further over the near term with the realisation of the UKCM synergies. And they comment on future earnings growth supported by record logistics portfolio reversion. So 27.2% increase in total portfolio value, as mentioned before, to 6.4 billion, following the acquisition of UKCM, with equivalent yield remaining broadly stable at 5.7%. And there's a 1.9% like-for-like estimated rental value growth across logistics portfolio for the period. And in addition to that, record 25.5% logistics portfolio reversion provides potential to capture £68.2 million of additional rent, of which £43.4 million is subject to lease events by the end of 2026, supporting future earnings growth. Growing rental income through active management and investment acquisition, they've commented that £8 million added to the annual contracted rent through rent reviews and asset management initiatives, 10.7% increase in passing rent across rent reviews and lease events in half year 24. 17.4% of the portfolio is subject to lease events during the remainder of the financial year, and £46 million acquisition of 500 million square feet in the East Midlands cold store let to Co-op with a 7.3% reversionary yield. 5.1% annualised rental growth across all leases subject to rent review in the period, and EPRA like-for-like rental growth of 2.1% over the period, reflecting lower number of rent reviews in this period. Finally, they comment on their strong balance sheet, which is well positioned to support the strategy, with 29.9% loan to value as of the 30th of June, and net debt to EBITDA of 7.1 times, compared with 8.2 times at the close of last year, and 3% weighted towards average cost of debt, with 95% of drawn debt either fixed or hedged. And the UKCM refinanced post-period end with a margin reduction of 70 basis points, and over £550 million of available liquidity and an average of 5-year debt maturity. And there's an upgrade from Moody's of Outlook, if you're interested, from Baa1 positive from Baa1 stable. Chief Executive, pretty pleased with the results. And in terms of the share price, let's just have a look at that. So the shares were largely flat on the results. In terms of valuation, Tritax has a market cap of around £4 billion and it trades at around 23 times earnings. I thought these results were really positive. It's clearly going in the right direction. I suppose you're seeing that in the valuation. And I think with all of these companies, it's on the back of a longer term growth trend. And I think particularly when you're looking towards storage for e-commerce. So it's a more defensive play on that trend, I would say. There are a number of competitors, and Tritax isn't the biggest. I know the Segro, which is, I think, got a market cap of over £10 billion, but it's certainly one of the dominant players. And it does seem to be overall a pretty well-run business. So I think you could do a lot worse. Obviously, you've got a fairly decent dividend yield on it. And I suppose that is, one of the attractions of these real estate investment trusts. And I think overall the strategy seems to be a sound one. Probably not one for me. I think I can come up with more attractive businesses, but certainly can't knock these results. Sam, what are your thoughts?
I think this is a decent set of results. The asset value increases and all that. That's just because they've gone and bought more assets and taken on debt to do it by the looks of it. That's reflected in the fact the actual earnings hasn't gone up a huge amount. That being said, long term, you think these kind of buildings that they're letting out, or it's the massive warehouses and stuff like that, you think long term you'd expect them to probably go up in price. So, if they've gone out and taken on debt to do that, it's not really the worst thing in the world, because if it goes up in value, they're still benefiting. But yeah, I think of all the REITs that, not that we really cover any REITs, but of all the REITs that I follow, which is very few, it probably is the most interesting. I did see it gives in the results. Did you see it gives a breakdown of some of the biggest customers?
I didn't, but
I mean, it's
you
sort
can.
of tucked away. You have to scroll quite far, and I was flicking through trying to find out find out how much more debt they'd taken on. So where is it? Here we go. So of their contracted annual rent, 12% comes from Amazon.
Oh yeah, I see it
The
now.
next
Sorry.
biggest is Morrison's at 4.7%. Then it goes to Iron Mountain at 4.3. 4.2 is Co-op. B&Q's 3.3. 3.2 is Tesco. 3.1 Argos. 2.9 Ocado. 2.8 M&S, and then 2% DSG Retail, which I suppose is pretty good actually, because it means probably most of the rent is actually coming from companies that have below 2% based on that. I mean, Amazon you kind of expect to be number one, but yeah, I do like it. I like the business. Do we have a PE for it?
I think it was 23.
That's quite pricey, isn't it?
Yeah,
The thing
yeah.
is, it's trading at a discount to the asset values, so it's a tricky one. But then, REITs normally do.
Yeah.
But I suppose I guess you probably would be willing to pay a premium for the fact that the assets are so strong. You're paying more for the balance sheet, I guess, than the income.
Mm.
As well, they're basically paying out all the 23, aren't they? Because they've got a dividend yield of 4.5%, and you'd hope you'd get that capital growth as well from the increase in the value of the properties. I don't think it's terrible. I think you can do a lot worse. I think what would really, like I say, of the REITs, it's probably my favourite. But that being said, the ongoing charge, they'll charge you 2% a year, which I know you won't really see. But when you're only getting a dividend of 4%, it does take a chunk out. But yeah, I do really like this business. But yeah, I think, like you say, there's probably more attractive businesses out there.
Fair enough. Okay, then. On to, do you own this one actually, Sam? Coca-Cola
I
HBC.
don't know. So this is Coca-Cola Hellenic Bottling Company, which we have covered multiple times. It's a favorite of the show. It's basically Coca-Cola, but in emerging markets mainly. So it's sort of Eastern and Central Europe, to be fair, and then sort of a few other emerging markets. They've got like Egypt and Nigeria and a few places like that. And I think they have something like 27 countries in total. Or it might be down to 25 because they also had Russia and Ukraine, which are basically gone now. So they have come out with their results for the 6 months ended 28 June 2024. And volume is up 3.1% to 1.426 million. Net sales revenue in euros, and all these figures will be in euros, is up 13.6% to 5.175 billion. I guess in the volume probably should have been billion as well. It's not going to be a million. Net sales revenue per unit case is up 10.2% to €3.63. Operating profit is up 1.6% to 566 million. The EBIT margin is down 20 basis points to 10.9%. Net profit is down 1.1% to 381 million. Basic earnings per share is down 0.7% to 1.043 euros per share. And free cash flow is down 14.2% to 220 million. And they've said that their strategic priority categories are all driving growth, with sparkling up 0.9%, energy up 32.8%, and coffee up 21.6%. And Q2 volumes grew 4.2%, with all segments contributing. They highlighted further value share gains with their share in non-alcoholic ready-to-drink up 170 basis points and sparkling up 80 basis points year to date. Said comparable gross margin grew 100 basis points, reflecting easing input cost inflation. Per segment, the established segment was up 4.4%, led by revenue per case expansion and a resilient volume performance. Organic EBIT grew 11.1%. In the developing segment, organic revenue was up 11.5%, driven by revenue per case expansion as well as volume growth. Organic EBIT was up 62.3%. And in the emerging segment, organic revenue was up 22.7% as they utilised revenue growth management initiatives to navigate FX headwinds in Nigeria and Egypt. Don't get us started on the FX headwinds in Nigeria. And continued to drive solid volume growth. Organic EBIT was down 8.6%. The comparable earnings per share of 1.04 euros was down 1.7%. And they said that's due to higher finance costs, which I think is interesting because we've seen the same thing in, which one was it? Entain. Was it Entain? I think it was.
Yeah.
I think it's sort of the first couple where we started to see that coming through now, actually. Monster Energy Green Zero Sugar launched in 16 markets in Q1, contributed to a strong performance of energy with strong ongoing activation through Q2. They continue to focus on driving mixability and premiumization, introducing innovation with Schweppes and Kinley, launching 3 cents in a further 9 markets, and expanding Finlandia vodka to 19 new markets. In terms of the valuation, the business trades at a P ratio of 18 and has a dividend yield of 2.9%. And the market cap's 9.85 billion. I thought these results were okay, but not amazing. They are on the back of some very, very good results, which I guess makes it harder. So I guess they managed to hold on after, the cracking year they had last year. It's not terrible. And I think in terms of those priority categories, they are all doing very well. You've got the coffee and the energy absolutely bombing away. So hopefully it looks encouraging. And I think they do need to be given credit, as we touched on last time. Obviously, a decent part of their business was basically just sort of obliterated overnight when Russia invaded Ukraine, because that's 2 countries that they operate in that are just gone effectively, or certainly not what they were. I mean, I think they've done incredibly well in that the results are now sort of above what they were then. The share price had a big wobble after Russia invaded Ukraine, and it's now basically fully recovered, and it's actually higher than it was prior to that invasion. So, yeah, I think these results are a bit disappointing, but it's on the back of a very strong year that they've just had. And I think overall, in sort of the, 3 years or however long it's been since we covered the show, I don't think we can really criticize these results. I think overall the company's done very well in the time we've covered it. So, yeah. What about you, John?
Yeah, no, I would largely agree on that. I think one of the things that's quite interesting is how well energy, but we know that is a growth market. The coffee, and I think that was, when Costa was bought by Coke, you can see the growth potential that was there. And you do wonder whether Whitbread did let it go a little bit cheaply, although it was $6 billion to them, because that coffee growth, still, 5 years on, possibly a bit more now, is still booming. So I think that's quite interesting.
Could you argue it would have taken someone like a Coca-Cola to unlock that value, though? Because it was really a UK coffee chain, wasn't it, at the time of sale?
Exactly. That's the argument. And it could it only have been done by Coca-Cola buying it to make it, I know it's nowhere near Starbucks, but to drive that forward. And I appreciate this is in maybe Central and Eastern Europe, and in some other markets as well, but particularly into that US market. And possibly the answer is it would require a backing of a company the size of Coca-Cola to do that. But it was something that stood out to me in the results.
Yeah, so they did say they added 1,500 outlets in the half for the coffee.
And I think the other interesting thing was, and this was reading an article about maybe 10 years ago, was that I think the Costa brothers sold out for maybe 1.6 million. And that was, but I think that was sort of 20 plus years ago. So it maybe took Whitbread to drive it to that next level. And then obviously Coca-Cola taking it from there.
Shall we move on to Disney?
Yes. So I think it is the favourite company of the show. So one we both own, and the company had their Q3 results out with revenue rising by 4% to $23.2 billion, which was ahead of market expectations as all business segments saw growth. In the entertainment division, declines in linear and sort of traditional TV networks were more than offset by double-digit growth in the direct-to-consumer, which contains all of Disney's streaming brands, but Disney Plus is the biggest. Operating profit rose by 19% to $4.2 billion, and subscriber growth and cost savings nearly tripled profits in the entertainment division, more than offsetting a single-digit decline in the other divisions. Free cash flow rose from $1.5 billion to $4.5 billion due to improved cash generation, and net debt rose from $32.2 billion to $41.6 billion since the start of the year. Full-year earnings per share growth guidance has been raised from 25 to 30%, and the shares were broadly flat in early trading. In terms of valuation, the group have a market cap of just over $156 billion, and they trade at 16.8 times forward earnings, compared with a 10-year average of 23.5, and they have a prospective dividend yield of 1.1%, which is in line with the average. I thought these results were actually all right. I guess when you've got a company, the quality and the traditionally having the earnings multiple that Disney has, you do expect a lot from them. I think it's very encouraging to see the direct-to-consumer continue with a double-digit growth. And I think as well with that, we've talked about it a lot, that they could turn that up in terms of the fees that they charge are still relatively low. So I think that is still a big growth driver and a big investment case for the stock. I think the entertainment, yes, you sort of expect the traditional networks to be in decline, and that's been something that we've seen over a long period since we've been covering the stock. And then the parks business, again, as well, it does nicely, but it's not something where you're expecting a huge growth. I certainly bought into Disney on the back of its probably the best IP of any company. And then also, I think the excitement about its direct consumer division, which I'm pleased to say is still doing well. It has had a difficult time. I think things are getting better under Bob Iger. And I think actually it's a fairly attractive valuation, if you were looking to start at Disney, because it's well below its 10-year average. Appreciate that the results have been a little bit more mixed over the last 18 months. But I think there's an awful lot in terms of the quality, the IP, and that future growth driver in terms of the distribution and Disney Plus subscriptions. So I hold it and I like it a lot. Sam, what are your thoughts on these results?
I thought the results were good on the income side. Very happy with it. I don't really get why the share price is now so low, because it was having quite a good year and it seems to have given all that back up. And like I say, now it just seems, I think, very cheap considering, you get it cheaper than Unilever and Diageo now. But the only thing I don't like, it's the same thing as last time. I've not really gone into the detail and figured out why, but I don't understand why the debt's gone up so much. Net debt up from... But is that
Should
maybe
we
just
just have a look?
the free cash flow's gone up? So I just don't get. I maybe check the 10Q, but I just don't get where all the cash has gone. I mean, it looks like the cash has gone down, so that could be the reason. Well, that will be the reason actually. So I don't think the debt pile's necessarily changed. The long-term debt hasn't really changed. It's just that the cash has gone down. So let's see where that's gone. Oh. I don't know what, but they've acquisition of redeemable non-controlling interests, 8 billion. That's where most of the cash has gone. That's basically the majority of it. So they've acquired non-controlling interests. So they must have had businesses that they partly owned that they've now gone up to have a full ownership or increase their ownership. I don't know what they are. Essentially, there's something that they've bought at some point and someone's kept a non-controlling interest and they've bought them out. So I don't know what asset that is, but I suppose that's not that bad because they've not increased the debt pile any further, although the cash has consequently gone down. But in theory, the assets have gone up. So that's not too bad, actually, because it's not like they've increased the borrowings or anything. So yeah, in terms of valuation, though, I think it's really cheap. I really like it. I find the share price slightly bizarre because I don't think there's really anything. I think if anything, I mean, the operating profit's up 19%. I think these results are very positive. And yet the shares are near 12-month lows. They're down, I don't know what they're down from the peak, but they're down from a year high of $123 down to 78.
Yeah.
And I can't see any obvious reason for that. As a shareholder, I'm pretty happy with the performance of the business. Yeah.
No, I'd agree. And I think, what do you think of the direct streaming up 14%, or revenue up 14%.
I'm very happy with that. I think they
Yeah.
had a strategy for the first 5 years or however long it was, where it's just let's go and get as many customers as possible. I think that strategy stopped working really, because you had it with like, you know, when they had all the Indian subscribers that they were losing because they'd lost the cricket rights and stuff. And that's not really what the Disney Plus was always meant to be about. And I know you want that other stuff, that almost fodder, but really it's to sort of give them the Disney IP, not to be spending money on those kind of rights and stuff. And I think probably the switch regarding, you know, going from acquiring as many customers as possible to actually we're going to start to increase the pricing and exercising the pricing power like you see in every other aspect of the business, I think was made at about the right time. And yeah, it's 14% this time, but I think that's going to be going up for a long, long time, hopefully, because I don't think they're anywhere near sort of what they could be charging. So yeah, so I'm very optimistic about that, and hopefully that will start to feed through more and more, which I guess is why I find the valuation all the more bizarre, really.
Yeah, no, fine. So of the companies this week, Ibstock, Entain, Hargreaves, Tritax, Coca-Cola HBC, and Disney, what would be your top pick? I mean, I think I can predict this, but what would be your top pick and what would be last?
Top pick's really, really easy this week. It has to be Disney. I think to get it under 17 times earnings, I mean, I thought you could make a decent argument for it at 25 times earnings, given the potential of Disney Plus. But under 17, I just think, yeah, like, well, why would you pick anything else over it? In terms of last, probably Hargreaves. I know it's a bit of a cop-out, but it's just a bit pointless buying it, isn't it, really? So
yeah,
I guess it would have to be Hargreaves, because you are going to get the same price back as what you're going to pay for it.
Yeah. No, fair enough.
What about you?
I would go for Disney, and I know it's boring, but it's a company I own. I think it's fantastic. And yeah, I think at the moment it's certainly a more attractive valuation than it has been for a long time. And last, I suppose you could have that argument for HL. I wouldn't. Entain's more sort of ESG reasons. It's difficult, actually. You could make the argument potentially for Ibstock in terms of valuation. It's quite a bit on the pricier side, but Tritax isn't exactly cheap. It's difficult. Disney would be my top choice. Maybe I'll have to go for HL by default for the same reason. Bit boring, but tricky there.
Right. I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.